Yeah, hello everybody and welcome back to my channel here. Today again, value-added tax. Now, last time I reminded you of some aspects of geography and value-added tax. That there is a very special way how VAT looks on geography. But now we are going to look more into details of cross-border transactions. So exports to third countries is probably the easiest way or the easiest kind of cross-border transaction. So let's have a look on that first. So we are here in the beginning of our chapter, and if we look to exports, then all in all, we will have to talk about the basics. We will have to remind you of some aspects of the rule of 3-6, so that the place of delivery is where the movement of the goods towards the customer begins. Then there will be some um, exceptions to be named, and then we know all the basics on exports. So let's begin with the basics. According to the basic principles of value-added tax, taxation should happen in the country of destination. So exports should only be taxed in that country to which they are brought or sent by the customer or by the deliverer or by someone else on the order of one of those. So that is a bit puzzling. Why is then an export taxable? And the answer is, well, if you allow a tax-free export, you must ask for proofs by the entrepreneur that the good was really and actually exported. If you don't ask for proofs for exports, then it's easily possible that you can sell a good without tax in the inland and then tell the fiscal authorities it was exported and is therefore free of tax. So if the seller could successfully just pretend something was exported, the whole system would break down, because then you would have untaxed goods competing with taxed goods in the inland, and that distorts the market strongly. For this reason, you need to establish a mechanism which leads to the right consequences and incentives if the seller cannot prove the exportation. That is simple. By the EU rules, an export is always taxable, and then in the next step it is made tax-free by a tax exemption for exports if the entrepreneur brings the necessary proofs. That now automatically brings along the right consequences in all cases where it might be doubtful if an export really took place, because the basic rule is, as you know, what is taxable and what is not exempt is liable to tax. Now, what is not proven to be exempt is not exempt, and so what is not proven to be exempt is then automatically fully liable to tax. That brings along a very strong incentive for entrepreneurs, suppliers, to have the full documentation and really foolproof proofs for an export. So whenever the proofs for an exportation leave the slightest doubt if that really happened, then automatically it's not proven, and then automatically things become fully liable to tax. And that, yeah, gives the accountants in the firm the necessary, let's say, lever over the management to insist in all these bureaucratic procedures to be fully and correctly done. Otherwise, it's 19% or so of your turnover gone away, and that turns every profitable transaction into a loss. So, yes, here by this mechanism you can achieve proper documentation. Nobody will ever take a risk that there is a slight doubt remaining, and so everybody will really do his or her best. So that is what you need to memorize, to keep in mind under all circumstances. Any examination of an expert must first lead in the first step to taxability, and that will be in the country of origin. So where the goods which you said were exported were last seen, that is where the movement towards the customer started. There is where the goods was last seen, and where um, where at last you could prove to have them still. Then you must end up with taxability. The adequate rules are just the usual ones. So paragraph 1, number 1, it's a delivery made by an entrepreneur. The place is in the inland of the country from where the goods were sent, so where they were probably produced and then sent to the customer, 3.6 sentence 1. And then in a second step, there will be then the tax exemption. And here we have two rules in play. Paragraph 4, number 1, letter A of the Umsatzsteuergesetz says that exports are tax-free, and paragraph 6 then says if something is an export or not. So a very simple structure for solutions. Let's have a look to paragraph 6, the definition of such an export. It makes a distinction depending on who carries the goods over the border or through the border control. In cases where the entrepreneur himself or his employee or the entrepreneur himself is naturally also his employee or the haulier acting for the employee or anybody else acting for the entrepreneur, where the entrepreneur himself transfers the goods through the border control to the third country, then the transaction is always an export. That is paragraph 6.1, number 1. However, where the customer transports the good through the border control, it's differently. There, the transaction is only qualified as an export if the customer is a customer from abroad, not an inland customer. That additional requirement, so if customer crosses the border to the third country with that good in question, that additional requirement can be seen in 6.1, number 2. By the way, paragraph 6.2 will then define what a customer from abroad is. But what is probably most interesting for us in this context is why. Why is there an additional condition posed? Well, think of the matter in a practical way. The customer, when crossing the border, gets the necessary documents and certificates and everything, all the proofs that the border has been crossed. Now it's the deliverer who needs them. And so the deliverer will have to beg the customer to pass on all these documents. And now imagine that might bring along some difficulties. The customer is perhaps a bit stupid or reluctant, or tries to make deals like, okay, yes, you will get your documents, but I have some, okay, let's call them unjustified complaints. So you get your documents which prove the tax exemption, but I get a discount of 10%, naturally retrospectively, because if you announce the whole maneuver in advance, contract would never have been concluded. But when you made that contract and made the mistake to deliver tax-free from the beginning onwards, then you would be completely in the hands of your customer. And so evidently the fiscal authorities or the legislating bodies try to limit that risk. They say, if you have an inland customer, we can have the whole thing far less complicated. We just tell you, sell your goods to that inland customer fully liable to tax, and your customer can then just deduct input tax. So in the end, it's a plus minus zero, but it's far more simple. However, and it saves you that problems running after the documents. However, where your customer is from abroad, that simplification doesn't work, because there are two potential reasons why people are opposed to that. First, the foreign customer. If you tell the foreign customer from France, Switzerland, or Russia, if you export something to Beijing, I will charge you VAT and you will get it back from the fiscal authorities on application and filling out German documents via internet or what else. Then the customer would probably say, no, far too complicated, I don't do that. So the transaction would fail. Second, the fiscal authorities have a problem if they have to pay out an input tax refund to a customer from abroad, if that can be avoided. Because once you paid out a refund to a very foreign customer outside the EU, you have a problem. If you had no time to check that properly, if some new facts show up, you never get that money back. And so both for the foreign customer and for your fiscal authorities, it is then even more convenient to oblige you to deliver tax-free an exported good if the customer is from abroad. The simplification that you just charge tax and the customer gets it back by input tax refund if customer is an entrepreneur, that simplification seems to be too complicated for a cross-border case. However, by the way, if you want to avoid that and say I deliver to an inland customer and that inland customer intends to bring the good cross-border, then there is always a way to secure the export exemption just by saying, okay, a customer, private customer from Cologne, buy a good and I order the entrepreneur to send that good to an address in Switzerland where my aunt or uncle lives to whom I intend to give that. So if the transport is made by the entrepreneur, you have never any problems with the export exemption, only if the customer carries the goods over the border. By the way, that reluctance of the fiscal authorities to pay back VAT amounts cross-border to persons who live in a country where they could never get that money back, that reluctance makes it understandable that legal rules deny the refund claim for any delivery which could be treated as a tax-free export. That can be seen in the VAT directive of the EU, Article 171. Yeah, so whenever you deal with an export, so when the good goes to a third country, it's always important to find out if you have a case of number one or number two, so who drives the good over the border. That's decisive here, and you so cannot simply say it's an export in the sense of paragraph 6. You need to decide for one of the two possibilities. Okay. Well, so let's illustrate these basics with a few examples. First example is a simple one. Mr. Exporter from Xanten in Germany sends a production machine for 200,000 euro to a customer in Canada who ordered the machine for his factory. Later he charges the transportation cost of 10,000 euro to the customer after he himself received the invoice from the haulier. What's the solution of our case? Well, let's have a look. First, let's ask ourselves some preliminary questions. Exporter does two things here for his contracting party for the same customer, so we have to ask if it's only one transaction or if it's two separate transactions. Now, selling a good and bringing it to the place where it has been agreed to that it has to be handed over there, that cannot be separated from each other. This is only one transaction. And the transport of the good to the agreed place of handing over is evidently only an ancillary element. That is not what you are primarily interested in. The primarily aim of the contract is to buy a machine, and this main element is the only thing which counts. You know, ancillary elements of a contract are ignored in the VAT assessment once you have found out that they are ancillary. So we only have the sale of a machine and everything what is paid to the deliverer under which reason and under which pretext ever is regarded as a part of the consideration for this production machine. So let's test the sale of a production machine. Is it a taxable transaction? We have to test 1.1 number 1 because 1.1 number 5 does not apply, is not possible, and we did not even know this before. So exporter is an entrepreneur, acts within his enterprise and for consideration because he demands a price. It's evidently a delivery because a machine is a tangible good and selling the machine is transferring the position like an owner to the customer. So we have a delivery, and so we only still need a place of delivery. That is where the transport of that goods towards the customer begins. 3.6 sentence 1, that is in exemption and that is taxable. So in the inland under 1.1 number 1. Now let's go to step number 2 in the testing scheme. Is there a tax exemption? The evident question is, is it an export if we send something to Canada? The entrepreneur sends the production machine to the customer, so it's a case of 6.1 number 1. Canada is a third country. I regard this as common knowledge. So no more is needed than proving that the exporting deliverer crossed the border with it. So the transaction is tax-free. Necessarily, you will have to keep the necessary proofs for this fact, and if they were missing, that would be a catastrophe. Well, the tax base might be asked for reasons of the tax declaration, because you also need to declare your tax-free turnover. So the tax base is a net amount 10.1 sentences 1 and 2, and as the amount is tax-free, the formula, which is usually everything which the seller gets minus the VAT amount included therein, leads to a simple result. The gross amount is here identical to the net amount because there is no VAT included. First, that amount is 200,000. Later, when an additional charge of 10,000 is done for the transport, this is under VAT aspects. Still an additional price for the machine because 10,000 for an ancillary element of the transaction, transport, that does not exist. Everything which is paid is always paid for the main element. So the 10,000 are also an additional later price for the machine. So 200,000 first and then 210,000 in the end. Input tax deduction rules. Well, exporter has a right to deduct as input tax the VAT which was charged to him for raw material or by the haulier, and so on, although the output itself which he has is tax-free, because exports can claim or do entitle you to input tax refund or deduction, even although or in spite of the export itself is tax-free. That can be found in 15.3 number 1 of the Umsatzsteuergesetz. Okay, so this was our first example, and what usually follows after the first example is a second example. Well, customer from Switzerland visits the premises of exporter's business in Xanten, Germany, and sees there a machine which he urgently wants to buy. Now he is in a hurry, and the price is 238, and so our Swiss customer, nervous as he or she is, says, I pay these 238,000 euro immediately and then take the machine to Zurich myself. That happens on the 29th of April in year 1. Okay, it's not always the realistic case, but things like that might happen, and just to illustrate how things would be done, then that is what the example wants to do. So it's further agreed that if the Swiss customer sends the exportation certificates where the border control confirms that the machine has been exported to Switzerland, that then an amount of 38,000 euro will be refunded to the customer by bank transfer immediately. So they say the price is 238 first, and when we get the proofs, then we give you back that part of the price, which usually would correspond to VAT. The documents arrive at Xanten on the 20th of May in the year 1, and now the question is, what is the correct solution of our case? Let's have a look. Let's begin with taxability. That's plain and simple, there is no problem in that. Exporter is still an entrepreneur, he didn't retire in the meantime. He acts within his enterprise, and for consideration, that's everything still the same as in the last case. It is a delivery under paragraph 3.1 USDG because a tangible good changes ownership. The place of delivery is again where the transport of the good towards the customer began under 3.6 sentence 1. That's Xanten, that's still in the VAT inland of Germany because it's neither Heligoland nor Büsingen, nor it is somewhere between the border line on the sea and the Strand. So the whole thing is taxable in Germany under 1.1 number 1. After taxability, we know we turn to tax exemption, and the test is if it is an export, because Switzerland is a third country. The machine is transported indeed to a third territory by the customer because the machine is brought to Switzerland. So we have a case of 6.1 number 2. The customer makes the transport. So we have additionally to check if the customer is a foreign customer. That is defined in 6.2, and indeed if the customer has established his business in a third country, he is a foreign customer or even abroad. So even a customer from France would be foreign customer. So the delivery is tax-free under 4 number 1 letter A as an export. The only condition is that the supplier has the necessary proofs, 6.4 USDG. And this is not the case in the preliminary declaration period, April, but from May onwards. So in the preliminary declaration period for April, it should be first declared as fully liable to tax. And then in May, this can be corrected into this was a tax-free delivery. In practice, however, one would probably choose a simpler approach. You would declare the transaction as tax-free, but would add a hint to the fiscal authorities that the full documentation is not yet present and will arrive later, and that you will inform them if the full documentation doesn't come. Without such a hint, just to say it's tax-free, although a few of the proofs are still missing, that would be giving wrong information, which leads to a tax advantage. Therefore, that would be suspicious of being tax fraud. So doing it the way I described would be the only tolerable way. The tax base is first 238,000 gross, and after proof is given, it's then 238,000 net, and then after you lowered the price by refunding 38,000, the tax base drops down to 200,000. And naturally, what is not stated here on the slide, because I had forgotten it, is the legal source for all that. That's paragraph 10.1 of the Umsatzsteuergesetz. And for later corrections, you could also have a look to paragraph 17, which says if the original consideration is changed, then that also counts for taxation. Then everything else can probably be left out. The only thing which you should not forget in the end is definitively the input tax situation. For that production machine which was sold to the Swiss customer, exporter will have had some input taxes, let's say for the raw material, and he is entitled to deduct the input tax Still, in spite of the fact that the export was tax-free, because exports are tax-free, but still entitled to input tax refund or deduction for the deliverer. That is a specific trait of exports. Well, third example. Exporter again from Xanten sells a machine to a German customer from Munich for 300,000 plus VAT. The German customer comes to Xanten and carries the machine immediately from there to a construction site in Switzerland where he uses them. He later sends documents which prove the exportation into Switzerland to exporter with a request to treat the transaction as tax-free and refund the VAT. And the solution is, well, as always, simple. So the solution is taxability. Exporter is an entrepreneur, acts within his enterprise for consideration, no problem. It is again a delivery because a tangible good changes the owner. The place of delivery is where the transportation of the good begins. That is ex ante under 3.6 sentence 1, so it's taxable. This is definitively true, whatever may happen now. And if it were an exam, these points would already be yours and would be undeniable. Now let's look to the core of that small case. We have to test if it's an exportation of a good. 6. We have a case where a customer transports the good into the search territory, so Switzerland, so it's 6.1 number 2. 6.1 number 2 says it's only a tax-free export if the customer is a foreign customer. Now a customer from Munich is a German customer, by the way, since 1871. So 6.2 is not fulfilled by a Munich customer, so it's not an export. So it's not tax-free. So it's fully liable to tax. And so the tax base is 300,000 as net amount agreed. The tax rate and tax amount is 19% because there is no special rule under 12.2 for machines. So 57,000 RQ. The taxpayer is the supplier, exporter, 13a, paragraph 1, number 1. The arisal of the tax is in the months where the delivery has been made, paragraph 13.1, number 1. The invoicing happens exactly as usual. Declaration duties are nothing special, everything as always, no peculiarities like wrongly issued invoices or other stuff. And the input tax deduction for exporter is still possible because he doesn't make a tax-free delivery. And apart from that, which I did not mention here exactly, is that also the customer from Munich, if that customer is a business customer, has a right to deduct the input tax for the good which he bought for his enterprise. Example number 4. The same customer from Munich buys again a machine from exporter and requires him now to send the machine directly to a construction site of his in Africa. Solution is now different. Taxability as before. Tax exemption, now exporter sends the machine to the third country, so it's 6.1 number 1, so the transaction is tax-free. The tax base, here were no data given with regard to the tax base. It's again recommendable to say that the input tax of exporter are upheld, although the own output is tax-free, and that's it. So this was just the first introduction to the basics of exportations, and you see that it plays a role who is the customer, and all the rest is relatively plain and just playing around with the legal sources to get some practice on that. Okay, goodbye till the next small video comes.